Business Finance Unit 2. Cash Flow 2.1 Importance of Cash in a Business 2.2 Cash Inflow and Cash Outflow 2.3 Cash Flow Cycle 2.4 Cash Flow Forecast 2.5 Cash Problems 2.6 Importance of Working Capital in a Business. Importance of cash in a business. Cash is the most liquid asset in a business. It is important for a business to spend on business activities and operations, to cover daily business expenses and survive, to repay investors and expand the business, to meet immediate as well as its long-term needs. Cash flow. Cash flow is the movement of cash into the business and outside of the business over a period of time. Cash inflows and cash outflows. Cash inflow is the money received into the business for a period of time, whereas cash outflow is the money paid out of the business during a period of time. Examples of cash inflows are cash sales, payments received from debtors, money received from a bank loan, money received from investors. Examples of cash outflows are payments of bills, purchase of materials, repayment of loans, purchase of fixed asset. Cash flow cycle. Cash flow cycle is the lapse of time between money paid for purchases of materials, bills and asset, to money received from sales and debtors. Cash is not the same as profit. Profit is the difference between sales revenue and total costs. A business may become insolvent or illiquid even if it has high profits. This is because sales revenue is made up of both cash sales and credit sales. Cash flow forecast. Cash flow forecast is an estimate of future cash inflows and cash outflows of a business, usually on a monthly basis. Cash flow forecast shows expected net cash balance at the end of each month and aid managers in decision-making when there is a future cash surplus or shortage. The net cash balance can be a positive net cash balance or a negative net cash balance. Positive net cash balance is when total cash inflows is greater than total cash outflows. Negative net cash balance is when total cash outflows is greater than total cash inflows. Cash flow forecast steps. 1. Calculate the total cash inflow. 2. Calculate the total cash outflow. 3. Calculate the net cash balance. Net cash balance equals total cash inflow minus total cash outflow. Net cash balance can be a positive balance or negative balance. 4. Add net cash balance to opening cash balance equals closing cash balance. Opening cash balance is the amount of cash held by the business at the start of a month or a year. It is also known as cash in hand at start or cash at bank at start. 5. Closing cash balance at the end of each month becomes opening cash balance for the following month. Step 1. Total cash inflow. Step 2. Total cash outflow. Step 3. Net cash flow equals total cash inflow minus total cash outflow. Step 4 is to add the opening cash or bank balance to the net cash flow. Step 5. Closing balance is net monthly cash flow. Add opening balance. Closing balance for Jan becomes opening balance for February. Closing balance for February becomes opening balance for March. Uses of cash flow forecast. Cash flow forecast is used to start up a new business because the owner will need to know how much cash she needs for the first months of operation. Operate and expand an existing business so that the business does not run out of cash due to overtrading. Take loans from the bank because the bank will use the cash flow forecast to assess the credit worthiness of the business. Inform investors about the cash position of the business so that investors are aware of how and where their capital investments are used to maximize value of their returns. Uses of cash flow forecast. Cash flow forecast shows the amount of cash a business will have at the end of each month. If cash flow forecast shows a negative cash balance, it means that the business has a cash shortage. So, cash flow forecast helps the business to decide if it needs to take a bank loan, bank overdraft, or cancel some purchases so as to improve its cash balance in the future months. If cash flow forecast shows a too large positive cash balance, that is, the business has too much of cash surplus, the business can decide to pay off its creditors, buy better quality materials, or invest in new machinery. Overcoming cash problems. Cash problems mean that cash outflows exceed cash inflows. 1. Increasing cash inflows by taking a bank loan or bank overdraft. Bank loan will inject more cash into the business for the long period, while bank overdraft will inject cash into the business for a short period. However, loans and overdraft must be repaid with interest, and so at a later stage, repayment to the bank leads to cash outflows. 2. Increasing cash inflows by asking early repayment from debtors or selling goods only for cash. Cash will flow into the business in the short term, however, in the long term it can damage customer relationship and customers will shift to competitors which offer better credit facilities. 3. Reducing cash outflows by delaying payment to credit suppliers. This will reduce cash from flowing out of the business. However, it is a short-term solution because suppliers may refuse to supply materials to the business if payment is not made on time. Also, the business will not benefit from any discounts on early repayment. Instead, the business may need to pay penalties on late payment. 4. Reducing cash outflows by delaying purchase of fixed assets and finding cheaper sources of supplies. This will reduce cash from flowing out of the business in the short term, and the money can be used to finance other urgent activities in the business. However, investment in latest fixed assets at a later stage is compulsory if the business wants to expand. Also, quality of its products may be affected if very cheap materials are bought. Working capital. Working capital is the money available in the business to pay for the day-to-day expenses. In accounting, working capital is the difference between current assets and current liabilities. A positive working capital indicates that the business is able to meet its short-term debts when they fall due. Importance of working capital for a business. Working capital means that the business has sufficient cash in hand or at bank to pay for its day-to-day expenses. Working capital means that the business has sufficient inventory to meet its daily production and customer orders. Working capital means that the business is able to attract customers, trade receivables by giving them credit facilities. Working capital shows the liquidity of the business. That is, it shows that the business has enough current assets to pay off its current liabilities when the need arises.